storage is getting increasingly full. I think the important thing, when we talk about crude prices is each crude price is a monthly contract. And what happened yesterday, we've been telling our investors was going to happen for 2 months. And that's basically that the beginning of the roll from the May contract to the June contract occurred. It actually formally occurs today. And this is the day when the physical market for crude actually syncs up each month, 1 day each month, with the paper market. And there is, due to the massive supply-demand imbalances, rising inventory, storage is getting increasingly full. And we even see that at Cushing, Oklahoma, where WTI actually physically trades in the town of Cushing, where there is, some of the largest storage capacity in the United States is filling up. We knew this was going to happen because for 2 reasons. One, we have been curtailed by refineries in the area. So that's by the mid-continent refineries that have already come to us on our operated production and said, cut back 25%, we can't take your production. So we knew that storage was getting very tight in the area. But the second reason we knew it was going to happen is because the mid-continent refineries were running scenarios in March of 10 to 15% demand destruction. And when you do, reference checks with some of the largest gas station owners and players like that in the market, what we saw in Oklahoma and Texas in the month of March is that demand was down 45 to 50% for both gasoline and diesel. So it just sort of showed you that the forecasting that the actual physical buyers of crude were doing in the market was not draconian enough to reflect what had already manifested in terms of really devastating demand destruction that happened so quickly in March.
That is amazing. So the refiners, even their worst estimates turned out to be way, way off as far as demand destruction. But it is important to note that I understand it got a lot of headlines because it was historic, but that May contract that we highlighted yesterday and the one that is still negative right now, Kate, that traded for a long time, over a year. So the majority of the contracts traded were not for negative oil. I would imagine it was just a tiny little percentage that did that on the far margin. What is the actual price of a barrel of oil right now?
Yeah, so, just to give you some context around this, so the negative trading, or the contract that traded negative, which is the May contract, was 7% of the volumes yesterday. The volumes yesterday were 60% less than prior month volumes. So what happened yesterday is sensational. It's historic. It certainly got everyone's attention all around the world, but it wasn't a real market in the sense that, like you said, this contract had traded for 5 years. And it was, really all that happened yesterday were about 108,000 long lots of the contract that had not closed out yet, closed out. And so the reason that this contract traded negative is because, basically some players went into yesterday long 108,000 contracts that were left to close out, and they were willing to pay rather than to be paid to not physically receive crude next month. That's what happened. So as sensational as it was, it really isn't as relevant. What's very, very important for all players who are trading the market to understand is that the rest of the forward contracts for 2020 and probably for the first and maybe second half of 2021 are still too high. We went into yesterday with the average 2020 contract for the remaining months of 2020 being $30 oil. That is too high when you have the level of demand destruction and the level of oversupply and the level of daily inventory builds that are occurring around the world right now. And so one thing we've been telegraphing to our investors, the forward prices are too high and they need to fall.